All right, we're looking at some gains on futures after 3 days of losses, the first triple daily loss in 6 months. I'm Matt Miller.
And I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, steady inflation, PCE data meeting expectations, giving the Fed some breathing room to address labor market cooling.
And another tariff push. President Trump announces a fresh round of levies on pharma, heavy trucks, and furniture.
Plus, sounding the alarm, David Einhorn warns the trillion-dollar AI spending spree may lead to tremendous capital destruction.
Well, Matt, when it comes to the movers this morning, kind of everything is moving on some sort of Washington policy that we got overnight. One of them being pharma stocks. They're moving higher this morning. Eli Lilly, Merck, Pfizer, all up more than 1% and 1.5% in some case of Merck after President Trump's 100% tariff on patented drug imports. The reason these are moving higher, though, Matt, is that he will have exemptions for companies that have U.S. manufacturing, and all of these have been in the process of trying to do just that.
Right. I know Novo Nordisk as well, building U.S. manufacturing. U.S.-based chip makers are climbing after the Wall Street Journal reported that the Trump administration is weighing a new plan to reduce U.S. reliance on chips made overseas. So you can see we have gains in Intel again, another 4% here, but global foundries as well as Texas Instruments, Dani.
Well, the reason all stocks are moving higher this morning, as you pointed to, Matt, capping those 3 days of losses, was U.S. consumer spending rising in August as core inflation remains steady. Bloomberg's Michael McKee spoke with Richmond Fed President Tom Barkin ahead of that data.
We have inflation moving in the wrong direction. Unfortunately, we also have unemployment moving in the wrong direction. We're very much focused on trying to land the plane here and balancing inflation and unemployment. You have to be very adaptive to what's playing out here.
Michael McKee, Bloomberg's international economics and policy correspondent, joins us now from Washington after that conversation and after the data. Mike, heading into the data was a market that was fearful it would be hotter than expected. That's not exactly what we got.
Well, it's interesting, Dani, because the market economists and the Fed have gotten very good at forecasting what PCE inflation is going to be. And it came bang on as expected with a 0.3 rise in August for the headline, 0.2 for core. Didn't really move the needle much on a year-over-year basis, a little bit higher for the headline. But the Fed knows that it's not where it should be, and that's one of the concerns that Tom Barkin had when we were talking about it. But at the same time, he noted that while they've been worried about unemployment as a sort of signal of what's going on with the economy, the consumer is hanging in there and they're spending like they don't have concerns. Consumer spending came in strong, up 0.6. Personal income up 0.4 as wages and salaries rose. So people still have the money to spend and they're still doing it. That's kind of what's keeping them going at the moment, Dani.
All right, Mike, we're going to continue to watch the fallout, the reverberations of these numbers on stocks. As I kicked off the show, I said 6 months. Yeah. The first time we've seen triple losses in 6 months. Actually, you're right. It's 1 month.
Okay.
Because we had we had 5 trading sessions of losses.
Okay, but doesn't it feel like it's been 6 months, or doesn't it feel like it's been like we've never had 3 days of losses? Honestly, that's what it feels like.
It really does feel like that, but it was like a month ago and change. So it's only been about 4 weeks, but it was a notable string of wins for the market. President Trump announced new industry-specific tariffs targeting pharmaceuticals, heavy trucks, kitchen cabinets, bathroom vanities, and upholstered furniture. Let's get into that with Bloomberg's Brendan Murray, who leads our global trade coverage at Bloomberg. So, Brendan, we did get a laundry list of things, of industry groups that President Trump wants to tariff yesterday, as opposed to countries. Is this his new tactic?
Yeah, it seems to be these industry by industry tariff authorities that he's using. We saw it earlier this week with robotics and medical equipment. So this looks like he's laying the groundwork for tariffs that he has a sound legal basis to impose. The country-by-country tariffs, those so-called reciprocal tariffs, are using a different authority that's being challenged at the Supreme Court. The Supreme Court could strike those down near the end of the year or early next year. So what the president's trade team is doing is using these 232 authorities to to protect industries that they think are vital to national security. Now, you could argue, why is my sofa a matter of national security? But there are issues, that those are issues that these investigations are going to have to address, and the industry is going to respond to them. You can imagine the users of all of these products, robotics, pharmaceuticals, are going to be in opposition to a lot of these tariffs. So we'll see what happens. But a lot of them have carve-outs, as was indicated earlier. European companies are only going to pay a 15% tariff, which is what they negotiated in their trade agreement with the U.S. And there are dozens of pharmaceutical companies, foreign pharmaceutical companies that are expanding their manufacturing in the U.S. The tally that the White House has is something like $325 billion worth of investments pledged. So President Trump's social media post last night was kind of a wake-up call to those companies and their projects, that if you don't have a shovel in the ground already, you better get it by October 1st, or otherwise you're going to face these sky-high tariffs.
I got to say, even calling them like sectoral tariffs or industry tariffs doesn't feel right, Brendan, when some of this is so focused. Okay, pharma, heavy trucks, fine, but upholstered furniture, kitchen vanities, what do we make of the fact it is so specific, Brendan?
Those could fall under the timber or lumber 232 investigation that's already underway. They can use the derivative products of those raw materials. So a semiconductor tariff could apply to your cell phone or your washing machine or anything that's got a chip in it, really. So they can apply these pretty broadly on products that are derivatives of the original subject of the investigation.
All right, Brendan, thank you very much for that. That's Bloomberg's Brendan Murray. Also moving this morning, the U.S. chip makers, Intel, Global Foundries, and Texas Instruments, all of them rising pre-market at least more than 2%. That pop comes on the heels of a report that the Trump administration is weighing a new plan to reduce U.S. reliance on foreign-made chips. Joining us now is Bloomberg Tech co-host Caroline Hyde. Caroline, maybe this move isn't surprising, but what method is the White House actually looking at to get companies to use more homegrown chips?
Well, I suppose the forcing and the prescription that for every chip that you have made in the US, you're going to have to it has to be equal and opposite to one that you're going to be importing. This is big news for the likes of Apple, for the likes of computer makers here, and more broadly, everything that has a chip in it, because you're going to have this 1-for-1 ratio. Who's counting? How are you going to be orchestrating that? Who's going to be saying that they're in compliance? But as you say, the people that it benefits are those that are manufacturing here in the United States. Intel, Global Foundries, maybe some of the analog ones, as I say, Texas Instruments. Who does it hurt? Well, I mean, Asia, chip makers more broadly, and those companies that are currently dependent on those Asia chip makers. Remember, this is what we've been discussing time and time again, and why Intel seems to be getting this influx of interest, money going into it potentially to fabricate here in the United States, but because everyone relies on TSMC. The question, though, is, of course, TSMC already has poured money into the United States, so too has Samsung. Have they put enough in America, manufacturing enough in America, that actually the overheads of this, it's more signal rather than actually what it is having in terms of an impact, in terms of noise?
I have to ask about the TikTok deal, because the valuation that J.D. Vance gave us yesterday, $14 billion, is far less than Facebook paid for WhatsApp in 2014, right? That was a $19 billion deal. And we're looking at a price to sales ratio of like 1.4, as opposed to other big tech firms where it's 8 or 10. So how unrealistic is this valuation?
It's like Exxon rather than Meta. I mean, more broadly, this is a lot of a pleasant surprise, perhaps, to the likes of Oracle and Silver Lake, who we understand, along with MGX, a Middle Eastern-based investment fund, coming in to own what we understand to be about maybe 35% of overall TikTok, as the reports go. What of the rest of the company? We understand less than 20% is going to be owned by ByteDance going forward. But there are so many more questions than answers here. Who are the other players? Now, is Susquehanna, General Atlantic, all the people who have currently owned parts of ByteDance, are they still going to remain current investors. We understand they're going to have 35%, so maybe it's about 45% that are owned by these names that have been put to the forefront. $14 billion, where have they got that number? Is it because that's basically equivalent to what their advertising sales are going to be in 2025? And as you say, a much less valuation than have been thought by Bloomberg Intelligence. He says, look, if you compare it to some of the other key social media companies out there, it's far more valuable. But actually, is it valuable? If you're no longer going to have ownership of the algorithm, you're going to license it. How often are we updating it? Is Oracle any good at algorithms? I mean, it's a cloud company and it's an infrastructure company. Yes, maybe it can monitor it for safety. Many people are saying that this is actually rather like Project Texas that was already in existence. Is this going to settle the national security issues? And more to the point, is China going to agree it? Because I read out more broadly what China has been saying, and they're currently really talking about the fact that they're responding the US side needs to provide an open, fair and non-discriminatory environment for Chinese investors. They haven't said yes. We understand Trump thinks he's got sign-off from Xi Jinping, but there's no formal statement coming from China thus far. Is ByteDance really going to swallow a $14 billion market cap for its prized possession? Maybe it actually is only worth that if they don't get the algorithm on repeat. And are we all going to suddenly segue out of global TikTok to become just a US TikTok? And what if other countries want to be using it too? There are so many questions. I don't feel much got answered at the White House yesterday.
Yeah, I've heard it described as daylight robbery. Someone said it's like they have a gun to ByteDance's head. Someone said it's the most undervalued tech deal in over a decade. So, yeah, a lot of fun at the expense of J.D. Vance and that TikTok deal. Caroline Hyde will be talking about that on Bloomberg Tech, a show she co-anchors with Ed Ludlow at 11 a.m. Let's quickly check on what's going on in futures, because after 3 days of losses, it does look like we're going to see a little bit of a bounce back here. S&P futures up 0.25%, NASDAQ futures and Russell futures both gaining more than 1/10.
And how's this for a bullish outlook? BMO just out with a note from Brian Belsky, who's already really optimistic usually, saying that his price target of 7,000 for year end might not be enough, and says, yes, let's chase this bull market. In fact, 7,000 might end up being too low. So the sell side's still incredibly bullish on where we go from here.
Yeah, we're going to actually talk to a more bullish guests throughout the show. We need to enlist some bears, I feel like.
Good luck finding them. Yeah, I guess is the thing.
They're few and far between, and that may be a bearish sign in itself. Coming up, Boeing is surging on a report that the FAA is easing restrictions for 737 MAX deliveries. That's the problem plane for them. That's next. This is Bloomberg. Let's get now to high interest. Look what's making headlines around the world. Former FBI Director James Comey has been indicted on charges of lying to Congress and obstruction related to testimony that he gave in 2020. The case comes as President Trump pressures the Justice Department to pursue his political rivals. Comey says he's not afraid, and his lawyer vows to fight the charges. If convicted, Comey could face up to 5 years in prison, and no matter what, he's heartbroken. The Ryder Cup tees off today at New York's Bethpage Black, with President Trump set to attend midday. His past sports appearances have drawn both boos and ovations, and organizers have added new security for the crowd with record ticket prices, packed trains, and a roaring New York fan base. The event is primed to be as much a test of politics as it is of golf. And remember, there are a lot of Europeans, obviously, that are going to be there. That's the point. It's U.S. versus Europe. Boeing is reportedly set to get more leeway from U.S. regulators. The FAA plans to let the company handle more final safety checks on its 737 MAX jets. That's according to the Wall Street Journal. The move could be announced today, alongside approval for Boeing to lift monthly output above the current 38 planes, a key step in its financial comeback. Dani?
And you can see the surge in shares there. Let's talk more about it with Bloomberg Chief Global Aviation Correspondent Sid Phillip. Sid, what do we understand from this report as to what exactly might be changing for Boeing in some of the regulation around them?
So for Boeing, this is an important step because before the crisis that the MAX had, Boeing was certifying its own aircraft, and that sort of helps them speed up the process, really, because with FAA inspectors looking at every single aircraft that needs to be delivered, it sort of bogs down the process. So the expectation is that once Boeing is allowed to certify its own aircraft and deliver those aircraft quicker, it'll sort of bring more cash in the door. And that's a crucial step in Boeing's comeback. Essentially, the 737 MAX is Boeing's cash cow. And the more 737 MAXs it can get out the door, the more cash it can bring in to its balance sheet. And so for Boeing, this is a crucial step, and it's been one that they've been trying to get since they've sort of reassured regulators and the public that they've sort of got a handle on quality, they've got a handle on their production processes, and they are building safe planes again.
We talk often, Sid, you and me, about Boeing's incredible underperformance when you look at it compared to its European ally, almost like a Davis Cup of, a Ryder's Cup, I should say, of airlines.
Nice.
What does Boeing have to do to get back on top here versus Airbus?
So Boeing needs to actually start delivering on the backlog. They have over 5,000 aircraft on their backlog, and the 737 MAX is sold out until the end of this decade. So what Boeing really needs to do is to try and get those aircraft out the door and into customer hands and actually get them flying. That's how they get paid. And so for Boeing, it's a crucial step of unlocking cash by being able to actually ramp up deliveries and being able to sort of, I mean, Airbus has out-delivered Boeing since the pandemic. And essentially, this is a crucial step for Boeing to actually start building those planes and getting them out so that they can actually start generating cash and competing better with Airbus.
So how much does this change things for them, Sid? How much does it speed up the process of them trying to get 737s out there to market?
I mean, it's still unclear what authority the FAA is actually going to give them, and also it's unclear how much leeway the FAA will give them, but it is a step in getting their planes out of the door. So it's not quite, this is sort of all hands off and Boeing can actually start delivering as many planes as they want, but it is a crucial step in Boeing's recovery and in Boeing's ability to deliver more aircraft.
All right, Sid, thanks very much. Sid Phillip covers global aviation for us. Coming up, David Einhorn says investors may not see a return on the capital spent to build AI infrastructure. We'll talk about that with Anastasia Amoroso, because obviously that's a big part of what's been driving this market to record highs. This is Bloomberg Open Interest.
Hedge fund manager David Einhorn is sounding the alarm on AI spending. Einhorn says the unprecedented amount of spending on AI infrastructure is hard to understand and may ultimately destroy vast amounts of capital. He drew a sharp line between the long-term importance of AI and the immediate economics of funding it, saying stakeholders may not see a payoff for many of the investment. Joining us now is Partners Group Chief Investment Strategist of Private Wealth. It is Anastasia Amoroso. Anastasia, great to see you this morning.
Good to see you, Dani.
And look, this is a topic you obviously know so well. Just analyzing it, and of course the work that Partners Group has been doing. With the vast amounts of money being put in, this isn't a new warning by any stretch of the imagination. Is there any merit to it?
Well, I think the warning is pretty interesting that it's happening this week, because we did get sort of a torrent of headlines, from globally about data center investing or just investing in AI infrastructure.
Alibaba said more than $4 trillion by 2030.
It's Alibaba, it's sovereign wealth funds, it's private equity firms. So it's been really a torrent of news. So I think it's right to scrutinize some of that. But if you take a step back and if you think about the demand for data center capacity, I'll just pick on data centers for a minute. It's really going to grow in the U.S. alone from something like 30 gigawatts now to 90 gigawatts in a future that's not too distant from now. So in order to get there, in order to satisfy that demand, clearly we do need to invest into that infrastructure. I think as investors, we do, however, need to be mindful of at what point you build enough capacity that is maybe we do reach that overbuilt moment. I don't think we're there yet, given the data center vacancy is something like 2.5%, but it is a concern. The other thing I would say, as investors, we have to think carefully about how we structure the contracts. And for example, for a lot of the data centers, these are long-term 10, 15-year contracts with further runway for renewals, and there are commitments that hyperscalers make, for example, to certain capacity, and some of them are take or pay. So there is a level of protection, I would say, for investors investing in the AI infrastructure.
But certainly, deals do need to be scrutinized.
Is there any concern about the circular nature of some of these investments? I mean, NVIDIA, for example, why would they invest $100 billion in OpenAI? Aren't they exposed enough to OpenAI that they don't need to be putting more money into one of their customers?
Well, look, currently it is a concentrated industry when it comes to building out the ecosystem, and it is a few players who have the competitive advantage in terms of technology, who also have the competitive advantage in terms of just having the finances to be able to do that. So there is certainly a degree of circularity, but at the same time, there's not that many other options. I will say, though, Matt, that more and more options are emerging in private markets, for example, and whether it's data centers, whether it's independent power producers, there are a lot of players that are also building out that capacity, and we're investing it in private markets.
But isn't there a timing mismatch? Because you have, for example, Oracle committing that they're going to build all of this stuff and getting a lot of funding and going to the bond market to do it. That's going to take some time to build out, and by the way, is going to need the power of like 2.5 Hoover dams to actually operate.
Yeah, for sure. And there's a race that's certainly on, which is how can we build these data centers and how can we power them as soon as possible? I do believe that the hyperscalers are doing the build out in conjunction with the demand that they're expecting to see. So I hope there's not a mismatch there. But absolutely, that's why for example, you don't really have a whole lot of price elasticity, and some of the tariff increases the data centers, for example, are able to pass through their customers because we need that capacity as soon as possible, and we need it now.
All right, we're going to keep you with us. We have a lot more to talk about besides just AI data center investment. It's obviously a huge part of this market. But there are more things. We got PCI this morning. We're all counting on Fed rate cuts. So we're going to talk about that with Anastasia Amoroso, as well as the private market piece that she mentioned. Check on futures ahead of the opening bell. We're looking at a 0.25% gain in S&P futures after 3 days of drops. This is Bloomberg. Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We are looking at gains on futures after 3 days of losses in the cash trade. S&P futures up 0.2%. NASDAQ futures and Russell futures gaining about 0.1%. PCE came in today without raising any red flags that might slow the Fed down in its rate cutting cycle, expected to commence with cuts at, well, it already had a cut last meeting, next meeting, and the final meeting of the year. Pearson ringing the bell at the New York Stock Exchange, I guess, in from London. The stock is up. It's more than doubled in the last 5 years for this publisher, 25 years listed on the New York Stock Exchange. And then Global Citizen ringing the bell down at the NASDAQ marketplace. They will be hosting a concert in Central Park. I'll be attending
Very cool,
tomorrow. Because I'm a big fan of Cardi B and Shakira.
Yeah, if there's one thing people say about Matt Miller, it's that he's Cardi B and Shakira's #1 fan.
Die hard.
Absolutely checks out.
Yeah.
All right, Matt, away from that, I'm looking at pharmaceutical stocks at the open this morning. They are all climbing. Pfizer a little bit less, 0.5%. Eli Lilly, Merck, those are up 1.5% and 1.2% respectively. It goes to who is building more in the U.S. because President Trump's 100% tariff on patented drug imports is weighing on things here. He will, though, allow for exemptions for companies that manufacture in the U.S. And again, Eli Lilly and Merck have been opening up plants and trying to do just that, Matt.
Yeah, so it looks like they've got a head start, and as a result, investors aren't terribly concerned. U.S.-based chip makers also climbing after the Wall Street Journal reported the Trump administration is weighing a new plan to reduce U.S. reliance on chips made overseas. It looks like the U.S. is going to require 1-to-1 chip content in manufacturers' products without triggering any big tariffs. So that could be a problem for Apple and others that get most of their chips from TSMC. We're back with Partners Group's Chief Investment Strategist of Private Wealth, Anastasia Amoroso. And this could be an issue, right? Although it looks like companies are finding a way to either be super nice and flattering to the president in order to get carve-outs, or what will companies that get almost all of their chips from Taiwan do when they're required to get some from the U.S.
Right. I think what they'll do is future commitments. That's probably the quickest way to sort of alleviate the administration's concerns about the being reliant on foreign supply.
So over the next 5 years, we promise to spend $400 billion in U.S.
I think that's the quickest way. But I will say, bigger picture, I think the companies are getting the memo from this administration, which is we do need to onshore certain capacity, which is considered to be mission critical for a lot of the industries. And certainly onshoring semiconductor capacity fits squarely into that. So whether it's current commitments, whether it's commitments to start, building out the factories in 2026 and beyond, I think that's the way you get around some of those most egregious tariff threats.
I know Matt promised we'd speak beyond AI and the amount of spending that they do. It is hard to do. But just one thing there that I can't get out of my head, and our Bloomberg News reporters had an excellent story about this, just the amount of times that these tech titans are tapping the bond market. Companies have raised about $157 billion so far in public bond markets. That's up 70% from what they issued in the same period last year. Should we be worried that tech as a sector is becoming increasingly more leveraged?
I think there's a distinction between larger cap companies and smaller cap companies. And for example, when you look at high grade, investment grade corporate, both debt ratios and sort of interest coverage ratios, they look very, very strong. If you look at the high yield market, you do see some weakening in the high yield market. So I think it depends on where the tech fits into that spectrum. But I will say for some of the larger cap tech companies, if they have cash on the balance sheet anyway, but they're able to take advantage of now lower interest rates and really near record tight spreads, I think that's exactly what they're doing.
I want to talk about whether we can hit new highs here, and everyone seems bullish. We have obviously been hitting record after record after record. I think the S&P has hit 28 new records this year, and President Trump says it's hit 48 new records this year, right. Although that's not true. I wonder if we're not all already holding as many equities as we can. I mean, U.S. households are the most overweight that they've ever been by many measures. Foreign investors own 30% of this market. They're also the most overweight that they've been in data going back to 1945. Like, who else is left to buy?
All right. Well, I think there's the technical side of it, and there's also the fundamentals, which is, can the earnings continue? Can we be comfortable with the multiple that we pay? And so let me kind of answer that question, near term versus longer term. And near term, I do think we're bound for some sort of a bump in the road, for some sort of consolidation, because we've come a long way in a short period of time. If you do look at some of the technical factors, we certainly overbought, and maybe it's the weaker or stronger than expected payrolls report next week. Maybe it's the start of the earnings season where the bar has actually been reset higher relative to other quarters where the bar is reset lower. Maybe something like that does cause a near-term consolidation. But having said that, we do look for another 2 rate cuts into the end of the year. So that's 75 basis points of monetary stimulus that will start to accrue. Dani, to your point, to some of the corporates that do have a lot of floating rate exposure, it'll start to accrue to the real estate market. And so I do suspect that will add stimulus into the economy going into 2026. By the way, on top of the tax cut stimulus that is still yet to come in 2026. So for those reasons, Matt, I do think the fundamentals into 2026 look strong. And, maybe you don't have this, huge momentum of buying, but if you have momentum of holding, that's solid as well.
It's a good way to describe it, but does the bond market play along? Because since the Fed's decision to cut rates last week, 10-year yields are up 14%. When that happened last year, everyone was decrying, okay, financial conditions are actually tightening as they're trying to cut. Are we headed for that again?
Look, I don't think so. I mean, the bond market, I think, reacted to economic data in the first half of the year that maybe was a little bit stronger than expected. But if you think about that, that is backwards looking data. I think the most important thing right now to pay attention to is the labor market weakness that is clearly upon us. So I would assume that whether it's next week's labor market data, whether it's the actual rate cuts that materialize in November and December, I would assume that does cap yields in the bond market.
All right, Anastasia, thank you so much for joining us this morning.
So
Always
much.
A pleasure
Great
to see you. That is Partners Group's Anastasia Amoroso. All right, let's get a check on what your equity market is doing. About 7 minutes into your trading day, we are moving higher this morning, up by about 0.7%, not undoing the 3 days of losses, as Matt pointed out, the first time you've seen that in 3 years. we are looking at European equities. So we're just going to quickly change that to US. So maybe the change is going to look different. There we go. We still are up. We're up 0.5%. You see Microsoft, Tesla, Alphabet's, a lot of the Mag 7 moving us higher. I actually want to go to what's moving us lower because the second one on here is interesting. It is Costco. Wow. Costco is moving down 3.5%, despite the fact that they basically beat on all metrics. They also said that they're going to shift more towards value-oriented and more essentials. In the pre-market, it was slightly higher, but that's turned a leg lower. Maybe expectations were high. I don't really know how so, since shares have gained, I think, only like 3% so far this year. Yeah, Matt, you can fact check me on that if that is correct.
Well, you were pointing that out this morning.
Yeah.
You know, they've done well over the last 5 years, but if you look over the last year, you know, before the bell, they were only up 3%. So with this loss, Costco is actually negative for the year. They're still up with reinvested dividends, though. 190% over the past 5 years.
Well, at least they have that. But, Matt, it is maybe a head scratcher. If it's a more value-oriented consumer, why wouldn't Costco do better? And they also talked about tariff mitigation. Let's also look at the sectors, because most sectors are in the green this morning. Actually, all of them, save for one. It is staples at the bottom. I mean, is that just Costco? Very possibly so, down 0.5%. At the top of the pile, it goes utilities, industries, energy. So it's very cyclical things that are leading us higher. And infotech also near the bottom of the pile. But again, Matt, most sectors in the green as we head higher by about 0.5%.
By the way, if we have maybe value-oriented investors, which normally we don't, right? Maybe that's why they're shunning Costco.
Yeah, do value investors exist anymore?
It's still trading at 46 times next year's earnings, and NVIDIA trades at less than 40 times.
Yeah, that's punchy.
All right, coming up, investors are mostly shrugging off a 100% tariff on patented drugs. We'll discuss that with Bloomberg Intelligence senior analyst Sam Fazeli. This is Open Interest.
Snapping 3 days of losses thanks to PCE data that did not come in hotter, which was the fear for this market. So yields move down, equities move higher by 0.5% for the S&P, NASDAQ 1/3%, and the Russell 2000 also around 1/3%. Let's look at some of the top calls, though. Some of the analyst action that we are looking at. First up, Wall Street weighing in on those disappointing Carmax results from yesterday. Evercore ISI and Wedbush both downgrade the online car retailer. Shares of Carmax had plunged to a 5-year low yesterday after a significant miss on earnings and sales. It appeared that tariffs really had a pull forward effect, and that has waned out. Next up, Warner Brothers Discovery, that gets cut at KeyBank. The analysts over there citing uncertainties surrounding that potential Paramount Skydance deal. They also say the valuation looks stretched and the downside risk is high. Shares down 0.6% this morning. But in the run up to it, Warner Brothers Discovery has been on a tear since August. Shares up 53%. Finally, Tylenol maker Kenvue, that gets raised to a buy at Rothschild and Redbird. Shares have been down 20% this month on concerns over Trump's announcement that pregnant women shouldn't take acetaminophen, the active ingredient in Tylenol. The analyst, though, said that recent health and human services proposals were less severe than feared, so those shares up 1.5%, Matt.
All right, so some of the upgrades and downgrades that we're seeing across the street. Coming up, the MSCI World Index is on pace to outperform the first time in almost a decade. It's truly monumental move, and we're going to talk about this with the chairman and CEO of MSCI next. We're happy to have Henry Fernandez here with us in the studio. This is Bloomberg Open Interest.
Well, S&P 500 returns have been solid this year. U.S. stocks have lagged other major stock markets. The S&P has underperformed benchmarks in Canada, Mexico, Brazil, Japan, and China. The MSCI World Index has advanced 15% this year and is on pace to outperform the S&P 500 for the first time since 2017. Joining us now is Henry Fernandez, chairman and CEO of MSCI. Henry, thank you so much for joining. Yeah. And obviously, your business is steeped daily in what these markets are doing. If you had told anyone that not just the U.S., but global equity markets would be hitting all-time highs, if you told someone that on April 2nd, I don't think they would have believed you. What do you just make of the overall health of markets today?
Well, for sure, they would not have believed it because a lot of people had been predicting a continuous strengthening of the dollar, for example. So a meaningful part of that outperformance of global markets is the weakness of the dollar, in addition to the local market rising. And across the world, a lot of markets were depressed. You know, we in the U.S. got used to this exuberant market, but in a lot of markets around the world, Europe, for example, China for a long time, even Japan, the markets were depressed. So you're now seeing a recovery and a catching up to the U.S. And on top of that, you have the currency.
So, I mean, your indexes are used by investors around the world as a benchmark. And I saw a stat this morning that I thought was pretty fascinating. Not only are European investors, or I should say foreign investors, heavily overweight U.S. stocks in their U.S. exposure, but in fact, of the $60 trillion in U.S. equities, almost 30% of that is held by foreign investors right now. So we have more foreign ownership of U.S. markets than we ever have. Why are they continuing to invest despite tariffs, despite President Trump? Is it maybe even because of those things?
Tech and AI.
I see.
And, you know, we are going through a major revolution, you know, in technology in the world. And there have been a lot of other market revolutions. You know, in the 1860s and 70s, railroads were, you know, the flavor of the day, and huge overcapacities was built in railroads, and then they crashed, and other people picked them up. So probably that's what we're going through here, is a massive investment.
Would you compare it to 1999 and 2000?
Probably, yeah. At this point, at some point, you know, all this investment, which is venture capital investing by definition, is not all going to pan out. So the companies that did good investments and benefit from are going to do well, but there will be a lot of them that won't, and therefore, you know, the markets are going to not be very kind to them at that time. But we're still going in that phase of discovery as to who are going to be the winners, who are going to be the losers. So since you don't know, you put it all across the market.
This is a market that's changed an incredible amount from the 90s, which is obvious. But I think one of the big glaring things that is often pointed out but forgotten is that the number of public companies since the 90s has shrunk by half. And there are other things that seem to be concerning about transparency. More companies are staying public, more are being taken private public. There are proposals from the president to allow companies not to report quarterly, but instead just do it twice a year. Your business is built on data and transparency. Is there a growing transparency problem right now?
In private markets, there is, for sure, because these are opaque markets, and that's the mission of MSCI right now. We're building what I call the MSCI of the private markets compared to public markets, which is you start with the data. You got to know what the fund is, what the fund does, you know, what are the companies, what do they invest in. Then you look at what is the benchmark of that fund relative to a market. And you say, what is the risk of that fund? What is the performance? So how does that compare to the public markets? How does that compare to other private market funds? So that's a major revolution that is taking place. We're leading that in creating that transparency in private credit, for example. But it's going to take time because, you know, what we have done in the public markets has been built for decades in terms of the norms, the standards, the data, you know, the reports, the benchmarks, all of that. And we're trying to do that in a few years in the private market. So we're really busy, you know, doing that. But that is should be an incredible facilitator of more capital, particularly individual investor capital, going into these markets.
So what's the breakdown look like in your business in terms of investment and revenue? Because you've got you know, a lot of shooting stars right now. You've got huge gains in foreign markets. You've got all of the AI and tech gains that you talked about. And then you've got this massive interest. I think 82% of fund managers want to be invested in private markets.
So we're very lucky that we have a lot of wind in our back in most markets. And therefore, we're catching all those trends in indexation, in risk management, in climate, in, you know, private markets and all of that. We're very fortunate that we have a high profitability in the company, about 60% EBITDA margins. and we allows
60%.
60%. It allows us to reinvest back into the business, and at the same time, buy our shares back and be very generous with the capital with our shareholders. So we've developed. When I took the company public 18 years ago, it was $18 a share. We're $5.70 today, with a market cap of $45 billion, and we think that that's small compared to what we can be in the future.
In terms of parts of growing business, there's been a lot of buzz, or at least there was at the beginning of this year, about, to your point, of growing private capital, but private capital ETFs. Apollo and State Street developed one together. And since then, it's gone a little bit quiet. I think they're putting a second one out there. But when you talk to clients who want you to develop indices that they can track to turn into ETFs, is there still a lot of clamoring for private capital ETFs? And how feasible and possible is that?
Well, the first step was to put this private capital into mutual funds, the interval funds, as they're called, which it allows for liquidity to be happening every so often, but it's not daily or it's not real time. So that's kind of been the first step. There's some, including others, that have tried to jump directly into the ETF market directly.
Do they do it too soon, do you think?
Yeah, it's hard because you need to, first of all, there's a mix, that, it's 85% fixed income, for example, public fixed income, and 15% private fixed income, private credit. The issue there is you cannot do that with that underlying liquidity of the private credit. So you can either have a market maker, give you that, or what we're working on is evaluated prices. So if you come up with evaluated prices in private credit, similarly to public fixed income, you're able to create a standard, well-trusted source of prices that people can value the NAV at, and you can trade the NAV. So that's, I think, the solution to that problem. In private credit, obviously, evaluated prices in real estate and in private equity may be more challenging, but that's the direction of travel.
Henry, great having you in here. Hope we can get you back soon. Henry Fernandez there is the CEO of MSCI. Let's dig in right now to President Trump's looming 100% tariff on drug manufacturers that they don't produce here in the U.S. Bloomberg Intelligence senior pharmaceutical analyst Sam Fazeli joins us now. And Sam, investors seem to shrug off this new announcement because a lot of drug makers already have started work on U.S. production facilities, right?
You got it, Matt. It's exactly what's happening here. At the end of the day, this is a 100% tariff that is written about in a short tweet or truth. I'm stuck with that tweet phrase. And I think the market realizes that most of these companies have already made their pledges, so we're looking good there. And in fact, there's no mention of most favored nation, so maybe we're not going to hear about that, although there's still room by the end of the month for that to happen.
Sam, only a minute here, but then who is at risk if all these U.S. manufacturers and even the likes of Novo Nordisk have started to try to build U.S. manufacturing?
Yeah, I mean, so obviously countries which are the base for a lot of these who've been used, they've been using before, such as Ireland and Switzerland, as a hub for manufacturing and shipping out. If they are going to be manufacturing everything in the U.S., so that takes a little bit of a hit. But of course, there's many other countries that you need to manufacture and ship to, and that's probably where they're going to be able to continue to do that.
All right, Sam, appreciate you jumping on with this story. Bloomberg Intelligence's Sam Fazeli, he covers pharma for us globally. Coming up in the next hour, Aoifinn Devitt joins us from Moneta on the possibility of a slower rate-cutting cycle.
Plus, we're going to hear from Egypt's foreign minister, who's going to be joining from the UN, and Fraser Yachts CEO. Talk about the demand for super yachts and how wonderful life is in Monaco. We're going to get all of that coming up next. You're watching Bloomberg Open Interest.
We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. Yes, equities are heading higher this morning after PC comes in line, but we are still on track for the first weekly decline in a month.
Coming up, steady inflation. PCE data meets expectations at 2.9% on the core, giving the Fed some breathing room to address labor market cooling concerns.
Another tariff push. President Trump announces a fresh round of levies on pharma, heavy trucks, and furniture.
And Rough Waters will explore how tariffs, sanctions, and global tensions are impacting the super yacht industry. And we'll touch on Dani's favorite principality, Monaco.
I mean, so many to choose from in terms of principalities. Anyway, speaking of consumer sentiment, we're getting the final numbers of University of Michigan sentiment. The current conditions reading and the sentiment overall weaker than the prelim, not by a lot, Matt. The prelim was 55.4. It comes down to 55.1. Perhaps a more exciting thing for this market is that inflation expectations are softer for the final print versus the prelim numbers. For your 1-year inflation look forward, it is 4.7 instead of 4.8 for 5 to 10 years. 3.7 instead of 3.9, so both inflation and current conditions lower than expected. So net, nothing much to see here.
Well, I think that bodes well for anyone looking for rate cuts,
yeah.
right? Because the concern is that high inflation expectations become anchored, and 4.7 over a year, it's still pretty high. I think we all expect the central bank and central banks around the world, to some extent, to let inflation run hot.
They're going to let it run hot, and it's a hot economy. President Trump saying moments ago that
hottest in the world.
The U.S. economic data is strong, and it has been strong. Let's get more on President Trump. One of our top stories this morning, the president announcing new industry-specific tariffs. That includes targeting pharma, heavy trucks, kitchen cabinets, bathroom vanities, and upholstered furniture. Let's get into it with Bloomberg Washington correspondent Tyler Kendall, who is still with us here in New York. Tyler, thanks for joining. So, I mean, a whole new round of tariffs. How do we divide up the buckets as to why exactly he'd tariff pharma versus upholstered furniture?
Right, it's hard to know where to begin. There's a few different trends that we can pull out of this real flurry of posts that we got from President Trump last night. One, all of these tariffs are going to start on October 1st. And the second, they were all enacted through a Section 232 investigation, which looks into these national security concerns. And that's why we've seen some of these real downstream products, like furniture, for example, that's stemming from a Section 232 investigation that was originally into lumber. And if we look at the timeline here, typically these investigations take about 9 months. Most of them were initiated back in April, so this administration is working on an expedited timeline. But tariffs on sector-specific are considered to have a more durable legal basis. And we know the administration is gearing up in about 6 weeks' time, November 5th. The Supreme Court will hear oral arguments on the more broad-based tariffs, those tariffs enacted under IEEPA. And perhaps that's giving us some insight into how the administration is rolling this out, because Matt and Dani, officials have told me time and time again, they're very confident that they have these other federal authorities to keep President Trump's trade agenda in place.
Can I ask about the retribution that President Trump is after right now with not only James Comey, but he put a new top prosecutor in place to go after Letitia James. And of course, he continues his battle to fire Lisa Cook, these perceived foes. I'm not sure if everyone expected this much in terms of legal action from the Trump administration when he was brought into office.
Right, and this perhaps, though, does continue the trend, Matt, that we have seen, although this is the first official, I believe, that has been faced with this indictment from the Russian investigation from 2016. We did hear from James Comey in a statement yesterday worth saying that he said, quote, "My family and I have known for years that there are costs to standing up to Donald Trump, but we couldn't imagine ourselves living any other way." So this is going to be a protracted legal battle like we've seen with many of the president's opponents.
All right, Tyler, great having you in New York this week. Thank you so much. Come back and join us more often. It's an exciting
You can't ask the
city.
Washington correspondent to be in New York more often.
She can't be in New York permanently, right? We've already established that.
Yes.
But, once in a while. Let's talk and get back to markets right now with Aoifinn Devitt, Moneta Chief Global Market Strategist. Aoifinn, we continue to see, we see again gains in these equity indexes. So risk assets once again on the up and up as we get University of Michigan data that maybe will make it easier for the Fed to cut rates. What kind of path do you expect?
I definitely expect the path to be a lot more cautious than markets had been expecting. One of the theses that we're really rumbling around with our clients right now is, what if the markets are better than expected? And then, of course, the counter argument, what if they're worse than expected? And the argument that they're better than expected is that this soft labor data that the Fed seems to be focusing on with their moderately restrictive policy, as they say it right now, that could actually be better than we think. It could be distorted by some of the immigration clampdown and the fact that there just hasn't been as much labor available for some of these jobs. What if those numbers are actually stronger? We know that consumers feeling better about everything. And we also know that there are $7 trillion plus in money market accounts sitting on the sidelines that will be earning less if rates come down. So where will those funds go? They will inevitably go into markets. So if markets are stronger, they really can't run hot.
Aoifinn, we heard yesterday from Stephen Myron that he considers these rates excessively restrictive. Is there a way that you can contort your view to see it that way as well?
I suppose if you take the lens of the property market, and we know that there has been this pain being experienced by investors seeking to get into the property market, and we know that affordability is a crisis, and they would certainly love to have lower rates.
That's been happening for decades, right?
I know. But that's probably the only lens whereby we can say that it is excessively restrictive. If we also look at some of the corporates that are experiencing that leverage. But we know that even the initial rate cut, the 25 basis points, did go against economic orthodoxy, with the market being as strong as it was. So the excessive restriction does sit at odds with what most economists would say.
So if this is an economy that's doing better, even I have to say Torsten Slok of Apollo had a note out that mostly would agree with you. He says you can't have an economy that's seemingly on the brink of recession with a weak labor market, but also at the same time accelerating and stronger GDP. He also points to maybe lower immigration and add in that some of the AI implementation. Even if that is the reality and this is a stronger economy, is that good or bad for stocks? Because in recent days, we have seen some of the stronger economic data send yields higher, and that be in turn bad for risk assets.
What I'd say, and I agree with Torsten, he's a friend of mine, I'd say that we should definitely expect that a stronger economy is good broadly for stocks. And that would include those sectors that have been languishing and left behind, because there can be then the consumer demand that we hope to see. I would still say that there's a lot of weakness among a significant body of consumers, particularly those that earn less. But let's just presume that the consumer is stronger. That bodes well for the 493 stocks, say, in the S&P 500 that have not been participating. But with all of this focus on AI demand and expenditure and whether there will be the productivity gains or not, I do think that those top 7, top 10 stocks representing 40% of the index will experience significantly more volatility. So broad-based, it's good. I think for that narrow sector, it is potentially boding to be more volatile.
I wonder about the technical aspects. I mean, everyone comes on this show and has also for the last at least 25 years and says there's a wall of money sitting on the sidelines. And I get that money market funds are over $7 trillion. But recent data shows U.S. households are more than 40% allocated to stocks. And even the most conservative data from Ned Davis is 35%. We saw today that foreign investors are 32% allocated to U.S. stocks among their U.S. investments. So is there any place for more money to come into this market?
There is. I think that if we look at how the retail brokerages have been emerging, we can see that there is a desire for more and more participation. And that's essentially how Main Street meets Wall Street. We spoke before about them being divided, and that the Trump administration back in the day was focused on Main Street, less on Wall Street. And we know that the two are really intertwined. So if Wall Street does well, the ordinary consumer will do well. I would think on the non-US investors, they may actually be thinking about de-emphasizing the US because of the weaker dollar, because of their desire to get more broad-based. But I think if we look at those over 7 trillion in money market funds, at Moneta, we strongly believe that that is going to seek yield, and inflation at 2.9% is not insignificant. That's an average. Really experienced inflation is a lot higher. You will need to earn more than money market rates to make that important in real terms, and you need to seek yield for that.
And also that 7 trillion, if you compare it with the run up in stocks too, it starts to look less significant, Aoifinn. But still, we see the sell side, for example, scrambling at this moment to try to up their price targets. I mentioned to Matt in the last hour that BMO's Brian Belsky said that his 7,000 price target might not even be enough. Aoifinn, at what point does this kind of start to get ridiculous, that it's just people kind of trying to defend their career, sounding more and more bullish, maybe not necessarily on the fundamentals?
Yes, I would echo that is a concerning indicator. And I look at other indicators such as canaries in the coal mine potentially. Look at some of the distress we've seen in a subprime auto lender and a car parts manufacturer. Just this week, we've seen signs of them tipping into bankruptcy. And why was that? Well, there simply wasn't enough due diligence done. There was that rush to capital, rush to provide capital that we've seen in the $3 trillion private credit business. So this rush to do anything is always a sign froth and a peak. So that is concerning, and that's why we're much more focused on the less exciting, less frothy parts of the equity market and the fundamentals there.
Aoifinn, this has been so fantastic. Thank you so much for joining us on this Friday. Enjoy your weekend. Aoifinn Devitt of Moneta. Coming up next, we are live from the United Nations with Egypt's foreign minister wrapping up a week of high-profile conversations as the president heads to the Ryder Cup. All that coming up next. This is Bloomberg Open Interest. All right, a check on markets this morning, and we are looking at the S&P gaining, but the Nasdaq turns to losses. It has been 3 consecutive declines for the S&P 500, the first time in a month. We did have not as bad as feared PCE data, which helped us out. Let's also now turn to the United Nations, an important conversation about to take place underway, where Bloomberg's Anne-Marie Horjern is standing by with a special guest.
We welcome our viewers on television and radio for this important conversation, as we've seen a ton of dialogue happen around this UN General Assembly when it comes to the changing geopolitical landscape. And I'm now joined by Egypt's Foreign Minister, Badr Abdelatty. Minister, thank you so much for joining Bloomberg.
Thank you so much for hosting me.
You were part of one of the most significant meetings to take place at this UN with President Trump and other Arab leaders. What did the president tell you about how the U.S. sees the path going in terms of ending this war in Gaza?
Well, I mean, it was a very, very encouraging meeting. It was positive, you know, to hear from President Trump his commitment as a president of peace to end this ugly war on Gaza, this aggression, Israeli aggression against innocent people from our point of view. So this is very important and encouraging, and also to talk about no annexation, to talk about developing Gaza where people will stay on their own land, and even those who left their homeland, they are entitled to return back. Those are very encouraging signals, of course, and messages.
Did everyone leave with a sense of unity about what the path is? And what is Egypt's role going to be in terms of the reconstruction?
Well, we have a unified Arab and Muslim position. We are in full support to the vision and the plan of President Trump to bring an end to this unjust war against innocent people in Gaza. For us, we have our plan. It's an Arab-Muslim plan for early recovery and reconstructions of Gaza, and it's endorsed by the international community, including European Union, Japan, Norway, most African countries. And what next will be, as soon as we have a ceasefire, then we will move ahead with hosting an international conference in Cairo.
When will that be?
Yeah, well, as soon as we have a ceasefire. So we are talking about 2, 3, maximum 4 weeks from having a ceasefire to host it. And we will have 3 events. One will be dedicated for private sector, for talking about security arrangement in Gaza, governance of Gaza, who will govern
Blair,
Gaza.
The former prime minister? Do you think he could be like the governor of this authority?
No. I mean, we are talking about Palestinian ownership. Of course, they have to govern themselves.
But what do you make of that idea that's being floated in the press?
Well, again, I'm talking about the Arab Islamic vision and the plan. We are talking about security arrangement. We are training, providing training of Palestinian policemen. We are accepting deployment of international forces within specific parameters. And above all, the governance of Gaza will be entrusted to a Palestinian administrative committee consists of 15 persons, all technocrats, all from Gaza Strip, and they will run Gaza for a transitional period of time till we manage to empower the Palestinian Authority to ensure the unity between Gaza and the West Bank.
Following the strike from Israel on Doha, what is the dialogue right now in terms of getting the hostages out and the ceasefire you're talking about? What is Hamas's latest deal that they decided to put on the table? Are they even there?
Well, first of all, you know, whenever we are reaching the moment of truth to conclude a deal which securing the life of the hostages, you know, the Israelis are intervening to destroy all those efforts, and this happened 100 times.
What about Hamas also intervening and destroying
Hamas,
efforts?
they accepted, you know, the deal of Witkoff, the proposal of Witkoff on August 18th, and we had a deal and everything was perfect, but it was the Israelis who backed off. He said, no, we will not accept that. So, I mean, we need a political will. We need a seriousness from the Israeli side.
Just a few weeks ago at the Arab Summit, President Sisi called Israel an enemy.
No, this is not true at all.
I read the translation.
No.
The transcript.
Go to the original
So what did he say? How do you characterize this relationship?
He said that, you know, we have to work together in the area stretching from the Gulf till the ocean. We want peace. It's a strategic option, and of course we have to deal with all hostilities with any enemy without specifying. Of course, we have different enemies in the region, but for Israel is we have a peace treaty with Israel, and we are honoring our commitment, and of course we have peaceful relationship with Israel. Of course, there are ups and downs because of the Israeli aggressions on Gaza, and that's is a main element of instability in our region. But at the end, we have peace with Israel, and we are honoring our commitment as long as Israel is honoring its commitment according to the peace treaty of 1979.
So it wasn't his intention to say Israel's an enemy, but do you think the 1979 peace treaty is at risk? There's been tons of acrimonious statements between the Israeli and Egyptian press.
Well, I mean, you can, of course, focus on the official discourse in Egypt. Of course, our discourse is focusing on Israel and a country with whom we have our peace treaty. Of course, the Israelis are spreading out allegations that there are military buildup in Sinai, and this is not true. This is nonsense. All movement of Egyptian troops or equipments in Sinai were conducted based upon an agreement with the Israelis during the period of the surge of terrorism in Sinai between 2011 till 2015. So everything was in full cooperation with them, with their consent.
But what do you say to those who think there's real chance of war between your two countries?
No, again, we have peace treaty. This is the main pillar of stability, of peace in our neighborhood, and we are fully committed to our peace treaty. Again, yesterday or the day before, President Sisi spoke openly, I mean, with the government that peace is a strategic option for Egypt, and we are abiding by our commitments as long as the other side is, the Israelis are honoring their commitments.
You mentioned Sinai. For the Palestinian people, this is a real humanitarian crisis. If vulnerable people want to come into Sinai, should Egypt let them in?
Come on, you know, let us be serious. There is no what's so-called voluntary displacement or forced displacement. Displacement is displacement. The Israeli intention is to eradicate people from their homeland.
But I'm talking about the Palestinian people. If they want to flee on their own volition because they are nervous, should they not be allowed in?
If those will leave their own homeland, they will not be entitled to go back, and that would be the liquidation of the Palestinian cause, and we will not allow this to happen. If you are making life miserable, unbearable, if you are starving people, if you have a man-made famine and starvation, if you are killing people systematically on daily daily basis, this is not a voluntary displacement. You are pushing people out of their homeland, and this is not acceptable. It's in clear violation to the Geneva Convention, to all norms. Why? There is no ethical or logical or legal basis for pushing people from their homeland. By making life miserable, you are pushing people outside their land.
Mr. Abdelatty, thank you so much for your time, and I look forward to the conference Egypt will be holding after there is potentially some ceasefire. That was, of course, Egypt's foreign minister. I'll send things back to you.
All right, Anne-Marie, thanks very much. Anne-Marie Hordan there with Egypt's foreign minister at the UN. Still ahead amid rising global tensions, we'll speak to the CEO of Fraser Yachts, going from one extreme to the other. U.S. billionaires are powering the giga yacht market forward. This is Bloomberg Open Interest. ByteDance is expected to get about 50% of TikTok's U.S. profits under the Trump deal. This, according to people familiar with it. Of course, ByteDance would not own 50%, a 50% stake in U.S. TikTok, but because of a licensing deal, because of fees that it would generate, according to people familiar with a Bloomberg story, it would still get 50% of the profit under this deal. And we're still looking for more details to come out. Of course, we haven't gotten a lot yet, just the broad sketches. But I thought it was interesting, Dani. Yesterday, J.D. Vance said it could be a $14 billion valuation. And I mean, that's so little compared to other tech deals we've seen in the last 20 years.
Incredibly little. You pointed out that WhatsApp sold for even more to Facebook many years ago.
11 years ago, yeah.
But maybe part of the reason that the valuation is so low is because of this revenue sharing agreement.
It's a very good point.
Maybe ByteDance is more willing to sell it for such a low valuation if they get 50% of the revenue. And the Bloomberg story goes on to say that they would also get some licensing agreement for the algorithm too. So maybe that's a lot of revenue that comes ByteDance's way, even if the valuation itself is quite low.
I think that's a great point. So our story says ByteDance, and we have been reporting this, would take a roughly 20% stake in the U.S. unit. But if it doesn't generate nearly as much money, obviously buyers like Oracle and others would want to pay far less, and perhaps the sellers would be willing to let go of it. Of course, we have heard President Trump say that Xi has okayed this deal, that President Xi of China has okayed this deal. We haven't heard that from the Chinese yet. So we're still waiting on more details to come out.
Yeah, again, and if the Chinese say anything. All right, away from that, President Trump's tariffs have had a widening impact not only on land, but also on sea. Fraser Yachts, the world's largest yacht broker, says that the market is split. Billionaires are driving demand for giga yachts, while millionaires are canceling orders. Joining us live from Monaco is Anders Kurtén, Fraser Yachts CEO. Anders, thank you so much for joining. This is interesting because it has been an economy that's being increasingly supported by the richest among us. But are you saying that's not even extreme enough, that it is the billionaires and not even the millionaires that are supporting things, just given what you're seeing in yacht purchases?
Well, actually, if we look back at the market as a whole, what we've seen, if we compare year-to-date 2025 to 2024, we've actually seen an increase on yacht brokerage transactions. Now, we tend to focus on the 30-meter plus segment, so the slightly larger side of the inventory, but we've had a healthy 5% overall growth in both transaction numbers as well as values year on year compared to last year. So this sector of the market is actually doing pretty well.
You're coming to us from Monaco, and you have offices all over the world. I think you have 21 offices and hundreds of employees. What kind of numbers are you doing in terms of sales? Like, how many 30-meter plus yachts are you selling per year?
A typical year for Fraser Yachts would be around 50 sales brokerage transactions in any sort of given 12-month normalized period. And that's actually been pretty steady. We are roughly at the same rate of transactions in 25 year to date as we did in 24.
Anders, how much did the war in Ukraine completely transform this industry from all of a sudden the reputational risk of selling to billionaires who might have exposure to things that cause geopolitical concern to yachts being seized, maybe difficulty in even going through sanctions to sell to those types of customers? How different are things now?
Well, I don't think they're fundamentally particularly different. It's good to understand that the entire, whether you look at the new build side, which is eminent yards producing new yachts, or the brokerage side, which is a super yacht services provider such as ourselves selling the pre-owned assets, the numbers of transactions on an annual basis, we're talking hundreds, not thousands, not to even talk about tens of thousands. And if we look at the bigger end of the market, let's say 80 meter plus, any year, we're talking just a handful, a few transactions. So analyzing this market to the seventh decimal, unless you look at sort of 3 to 5 year development cycles, really easily leads you astray. But what makes it problematic looking back, figuring out what's the normal, is that the pandemic was essentially a market aberration for us. Now, for our sector, it was happily a positive market aberration. But nevertheless, I guess what we're seeing is a normalization of the market, but we're still at healthy levels, quite significantly above pre-pandemic sort of average levels of sales, whether you look at new builds or brokerage transactions. And interestingly to boot, we also do yacht charter, and this last season has been the best ever in recorded history for us. So there seems to be a healthy appetite for the super yachting lifestyle, despite all the uncertainty we're seeing in the world currently.
A lot of that uncertainty has to do with the complexity of tariff orders. How does it look from your perspective? And I mean, if I buy a second-hand yacht that was made in China, for example, and try and bring it to the U.S., do I have to pay a tariff on that, or is it only on new builds? And are you seeing a shift in the production in terms of where shipyards are located?
We're not really seeing a huge shift there. I mean, if we look at the super yacht sector, Italy is #1 in the world, closely followed by actually Turkey these days. But what is sort of preeminent, if you're looking at the bigger inventory, typically they wouldn't be flagged under the flag of the owner's nationality. Quite often they use different flag states, so as such, even if they're new, the tariffs don't really apply. What we're seeing sort of as maybe an effect of the overall uncertainty is that the brokerage transactions and new build contracts might take slightly longer to negotiate, but the overall demand is still very, very good, and the market outlook is actually positive for the next 12-month cycle.
Anders, geographically, where is the demand coming from? Which consumer in which region are you seeing the most desire for the giga yachts, for the super yachts?
I would also ask if the buyer's nationality differs from the flag that buyer places on the yacht.
I'll answer the second question first, and typically the answer would be yes. If we look at super yachting as a pastime or endeavor, generally it requires a couple of things to sort of really thrive. It requires history, culture, infrastructure, and destinations, and thus the sort of predominant destinations. About 70% of the traffic is in the Mediterranean, and then the remainder predominantly Caribbean, Bahamas, then with a little fraction going sort of further north or south to more exotic destinations. As to the buyer's nationalities, #1 is, not surprisingly, the US, closely followed by Europe. And that's about 75% of the market, and the rest is really then split between all various remaining nationalities.
Anders, it's Climate Week here in New York, so I'd be remiss if I didn't throw in a question about how these super billionaires on their 30-meter plus yachts are thinking about Mother Earth. I know that you've actually put into place some policies that help buyers determine whether or not the yachts they're buying are greener than others, right?
That is absolutely correct. I think it's been a pretty exciting time from a sustainability perspective in the super yacht industry these last 10 years. And if we start with the new build sector, the technological options that we have at our disposal, whether it's full electric for a sailing boat or diesel electric hybrid for a power boat, or even more exotic propulsion alternatives such as methanol and hydrogen, which can be used, and yachts already have been built using them. So for a buyer who's really interested in maximizing the sustainability in his project, we have a number of different options which we didn't have before. Then on the sort of usage side, because that is generally where the big sustainability footprint comes from, the life cycle emissions of the yacht, there's a couple of things that we can start doing. Per yesterday, on most of the newer yachts, we can switch over to a synthetic fuel called HVO, which will slash all emissions except particle emissions by 80%. And since most of these yachts spend over half their time moored in a marina, if we choose a marina with green shore power, we have dramatically reduced the environmental footprint of this particular endeavor. We as a company, we've partnered with the Water Revolution Foundation, who has something called the YETI Index, which is short for Yacht Environmental Transparency Index, which allows you to combine yachts of a similar size range from a sustainability perspective. And we're seeing a little bit of traction with that, especially on the charter side, where some consumers are actually, if they want a selection of yachts within a certain range of parameters, they want to rank them from sort of least to most sustainable. So we are actually seeing a little bit of demand movement there. So really long-winded answer to your short question, but is there demand for that amongst the customers? Yes.
Well, it's good to hear because on the surface, there does feel a bit of irony to have the Monaco Yacht Show happening at the same time as Climate Week. So good to hear that there is progress being made there. Anders, thank you so much for joining us. That is Anders Kurtén of Fraser Yachts. All right, let's get a check on your markets this morning. More than an hour into your trading day. And let's, I guess, look at some of the single names moving this hour because Boeing is among them. Or we'll look at stocks first.
No, let's go back to the indexes.
You're looking at it. Thank you, Matt, for that. The S&P 500 up about 1/4%. The Nasdaq really struggling to hold on to gains. It was down much more severely earlier. Little change this morning, but slightly lower with the dollar losing steam too after both economic data from PCE and University of Michigan sentiment survey seemingly enforcing that cuts can continue apace.
Now we will take a look at some of the single names.
Thank you, appreciate it.
Let's pull Boeing back up here. Getting more leeway from U.S. regulators, the FAA plans to let the company handle more final safety checks on its own for 737 MAX and the far superior 787 jets prior to delivery. I don't like these narrow, like single aisle, small planes.
But what if you just have to like go somewhere quick? Like a little city hopper.
I'm too
That's
big.
fun, right?
You know, they prepare, the airlines prepare these planes for someone who's more like 5'5", 5'4", you know?
Yeah.
And I'm 6'3", 200. I need my space. It's just...
Literally having too long of legs are struggles that I will never know, and I'm envious of that struggle. Anyway, this one I'm really interested in, Matt. Shares of Costco. They've been getting hit pretty hard this morning. I guess they had mixed results, but I have to say they beat on a lot of metrics, and they talked about a value-oriented consumer going to Costco, and they're going to offer more value-oriented products, especially for the Christmas season. To be fair, their comps decelerated from the prior quarter. Global membership renewal rates also slightly declined too, but shares down 2.2% this season, even though, again, it's one of these companies that does have a value offering with a more picky consumer right now.
Yeah, I would have said it's buy the rumor, sell the news trade, but it's not done well year to date, right? Even over the last 3 months, they're down 6%. Over the last 1 month, they're down 2%. So it's been a rough trade for Costco. U.S.-based chip makers are climbing after the Wall Street Journal reported the Trump administration is weighing a new plan to reduce reliance on chips made overseas. So as a result, maybe you'd expect Apple to come to the table and do a deal with Intel. Maybe Dell is going to have chips made here in the U.S. with Intel. They're not the only one. Global Foundries, Texas Instruments also gaining, but the idea, according to the Journal, is that the Trump administration is going to require a producer of goods to buy one chip in America for every chip that producer buys in Taiwan.
It was the next logical step. We buy a stake in Intel, and then we make companies buy Intel chips.
That makes sense.
Yep.
Coming up, it's been 20 years since Hurricane Katrina devastated New Orleans. Wall Street Week explores how far the city has come since and where rebuilding efforts are still needed. This is Bloomberg Open Interest.
It's time now for our Wall Street Week conversation. 2 decades later, Hurricane Katrina remains the costliest natural disaster to hit the U.S. David Weston travels to New Orleans to see what it took for the people and businesses who stayed to rebuild their shattered city.
This is the dining room that in 1856, when Antoine bought this building, that he was operating Antoine's restaurant in. This is the building that had all the major damage in Katrina. And this building and these beams above our head were made of cypress. And when the building came apart, it put all the pressure, all the weight of the building down on these cypress beams above these columns.
As devastating as Hurricane Katrina was for Antoine's and the French Quarter and the rest of the city, it was the lower Ninth Ward that was hit the hardest, not by Katrina itself, but by the pressure the storm put on the levees, which eventually broke.
One reason the lower Ninth is called that is because it's lower on the river and it's beyond the levees on the Industrial Canal. In other words, if you're upriver from the levees, you're in the upper Ninth or you're in the 7th Ward or other places. That makes it harder to protect. It's further downriver, it's lower level.
The difference with the lower Ninth Ward was that the levees broke in such a way as the rush of water pushed the houses off their foundations. Unfortunately, that makes it much more difficult to rebuild. The lower Ninth Ward has therefore had much slower recovery rates than much of the rest of the city. I think about a third of the population is back. And it's incredibly sad because that was an area that had higher home ownership rates than the city average. A lot of folks there who were craftsmen, helped build across the city, built their own homes. And a lot of the properties were handed down to grandkids and great-grandkids.
All this grass and high weeds, all that was houses and businesses.
One of those residents who did come back is Brunel Cotlin. He grew up here and spent his life savings to open the only grocery store in the lower Ninth Ward.
My childhood dream was to be a policeman. So I ended up joining the United States Army, and I was the police of all places in Germany. But unfortunately, I came home just in time for Hurricane Katrina. After I rebuilt my personal home, I noticed we didn't have anything. We didn't have any grocery stores. We had nothing. I called up every big box store you can think of, and I begged them to open up a grocery store here in the lower Ninth Ward. So I said, well, you know what? Since they're not going to build anything, I'm going to build it. Before I opened up these doors, I had a small grocery store window that's right in the back. I opened that window up in 2009. I was selling everything out this little bitty window, and I had to save up all my money before I had enough money to open up these stores. I sold everything out this window. Milk, eggs, bread, cheese, you name it, it all went out this window.
And that was David Weston in New Orleans 20 years after Hurricane Katrina. You can catch Wall Street Week tonight and every Friday at 6 p.m. New York time.
Coming up, investors are gearing up for a week full of event risks. That includes a U.S. government shutdown deadline and a payrolls report. We'll have your calendar for you for your busy week next week. That's coming up next. You're watching Bloomberg TV.
Now let's take a look at what's ahead for markets and the economy next week. On Monday, Christopher Waller and Raphael Bostic kick off another busy week of Fed speak. On Tuesday, we get the all-important JOLTS data, as well as the latest report on consumer confidence from the Conference Board. The U.S. government is set to run out of funding at 11:59 p.m. on Tuesday unless lawmakers can agree on either a new budget or a stopgap funding bill.
Then on Wednesday, that brings with it ISM manufacturing and on auto sales. And then Friday, the big one, it is the September jobs report, which could reinforce expectations for further rate cuts if the print is weak. But will we get that if there is a government shutdown? Joining us now is Bloomberg Economics U.S. economist Stuart Paul. So Stuart, I guess that's one of the risks, that maybe if there's a shutdown, we don't even get payrolls data. But is this one maybe more impactful if you have a president who is saying that there will be massive firings across federal agencies if there is a shutdown?
So we've already seen that negotiating tactic or that threat has increased the probability of a shutdown. When I think about it in terms of aggregate economic activity, I'm already anticipating a major decline in total government employment, and it's going to start showing up most likely in October, but it could start emerging in the September payrolls report that we get. And these are the folks who took the Doge buyout and who start rolling off government payrolls 9 months after they agreed to that buyout. So under any set of circumstances, government within payrolls is going to start showing a decline, and we're going to see a little bit of cooling in the labor market as a consequence.
So yesterday we got initial jobless claims at only 218,000, and that was lower than the lowest forecast in our survey, which confuses me. Is this jobs market weak or is it strong? I mean, unemployment is still at a level that's among the lowest I've seen in my lifetime, and I'm over 50 now.
You bring up a really interesting point with jobless claims data, because folks are seeing the low layoffs and they are thinking that we could see an upside surprise in payrolls. I'm putting basically zero weight on September unemployment insurance claims data, because throughout the month, the data were completely packed with fraudulent claims in Texas that caused a spike early in the month, and then normalization is leading to their decline right now. We see other sort of data collection issues in North Carolina. Reading from the unemployment insurance claims data into payrolls is really hard for September. We should have a more normal read in October. When we look at higher frequency private data sets, it does look like payroll growth is set to register about 55,000 jobs for September. And that's about the pace that's consistent with labor force growth. So we should still see that 4.3% unemployment rate.
It's so strange, because when I talk to the big data guys, like when I talk to Ed Hyman at ISI, he always tells me this Thursday jobless claims report is one of the most trustworthy and consistent pieces of data that he can get. But now we're seeing that it's filled with fraud.
Well, I guess that's why revisions are good, right? And why we should always have revisions, because it can maybe get rid of some of that fraud. But to your point, Stuart, the expectation for next week is 50,000. Is that the new break-even rate? Do we look at 50,000 and say, in the past, that would have been a bad number, but now, yeah, because of immigration, that seems about right?
It is about right. I actually think that 50,000 might be a smidge higher than our actual break-even rate. Labor supply is growing really slowly right now because immigration is really slow. Deportations are actually taking a toll on the U.S. labor market and labor as an input to production of economic output. So this balancing act that we have right now in the labor market is really tenuous. If we were to see layoffs, that would completely change the labor market landscape, and that's why the Fed is trying to get ahead of that by restarting rate cuts as we saw.
All right, Stuart, great having you on the program. Thanks so much for joining us. Stuart Paul there. You can follow his work on Bloomberg Economics. Let's get a check on the markets as we head to the top of the hour here. Still looking at gains on the S&P, about 0.2%. The NASDAQ still negative, about 0.1 right now. And the 10-year yield at 4.16 coming off a little bit. We do see a little change at the shorter end of the curve.
All right, coming up on Monday, a stack show for you. RBC's Lori Calvasina will join us, as well as PNC's Amanda Agati, Laura Holson of New Mountain Capital and Private Credit, and the Norwegian CEO, Harry Sommer. This is Bloomberg.